Hello, traders, and welcome back to Explain the Charts. Today, July 30th, 2025, we're conducting an extensive, in-depth analysis of XAUUSD, the global gold spot price, by meticulously integrating the very latest market news with detailed candlestick chart data. Current financial headlines are undeniably buzzing with significant movements in the gold market, specifically highlighting its recent actions of testing new lows and decisively breaking crucial historical support levels. Multiple credible reports confirm what technical analysts have been watching: a pennant breakdown, a classic bearish continuation pattern, which explicitly puts gold's previously established uptrend at considerable risk. The overarching sentiment across major financial markets currently leans heavily towards bearish pressure for gold, largely attributable to the continued strength observed in recent U.S. economic data. This robust U.S. data bolsters the U.S. dollar, making dollar-denominated gold less attractive, and is compounded by the palpable anticipation surrounding an upcoming Federal Reserve decision, where hawkish signals could further weigh on gold. It's vital to recall that gold often functions as a quintessential safe haven asset, meaning its value typically appreciates significantly during periods of escalating global economic instability or geopolitical uncertainty. However, conversely, persistent strong economic indicators, especially from the U.S., can sometimes diminish this safe haven appeal, leading to capital rotation out of gold. To begin our comprehensive deep dive into XAUUSD, let's first examine the daily chart, providing us with a broad, macro perspective of its performance over the past year and a half. Looking at the period from early March 2024 through well into May 2025, we can clearly identify a robust and sustained uptrend, showcasing gold's strong underlying demand during that extended period. However, a notable and distinct shift has emerged since mid-June 2025. We've clearly observed the initiation of a broader corrective pattern, distinctly characterized by the consistent formation of successive lower highs. This pattern strongly suggests that bullish momentum is gradually fading, and sellers are progressively gaining more control of the market dynamics on this higher time frame, indicating a potential reversal of the long-term trend. Pay close attention to the peak around $3,433 in mid-June, followed by a lower peak around $3,427 in mid-July, confirming this developing downtrend structure. The volume profile on this daily chart also warrants attention, with recent downward moves often accompanied by higher volume than subsequent rebounds. Now, let's transition our focus and zoom intently into the 1-hour chart, concentrating specifically on the very recent, high-impact price action spanning from July 27th up to the current moment on July 30th. This more granular view is absolutely crucial for precisely understanding the immediate, tangible impact of the breaking news we just discussed regarding gold's decline. The news emphatically highlighted gold breaking its key support at the $3,302 level, and indeed, our chart data provides undeniable visual confirmation of this critical event unfolding on July 28th. More precisely, around 13:42 Universal Time Coordinated on July 28th, we witnessed a dramatic and swift plunge in gold's price, culminating in a low of $3,305.78 for that specific hourly candle. This is remarkably close to the widely reported $3,302 broken support, suggesting an immediate market reaction to the news and potential stop-loss triggers. This precipitous drop, importantly accompanied by significant selling volume, definitively validates the pennant breakdown pattern highlighted in the news, underscoring the formidable and aggressive selling pressure that suddenly entered the market. Following this substantial downward move, the market has surprisingly managed to stage a modest, albeit somewhat hesitant and technically weak, rebound. The price has slowly, incrementally climbed back towards the current levels, hovering around $3,327, indicating some initial attempts by opportunistic buyers to step in, perhaps seeing value after the sharp decline. This short-term rebound could also be attributed to profit-taking from short positions, as traders lock in gains after the rapid price depreciation, rather than strong new demand for gold. However, it's vital to note that while a bounce is present, it conspicuously lacks the aggressive, conviction-driven buying volume that would typically signal a robust and sustainable trend reversal at this juncture. This suggests the path of least resistance remains to the downside, with current buying merely a reaction rather than a fundamental shift in sentiment. Drilling down even further into the 15-minute chart for the exact same critical period, we gain an even more granular and forensic understanding of the intricate, high-frequency volatility surrounding that pivotal $3,302 level. On this accelerated time frame, you can observe with remarkable clarity just how swiftly and dramatically the price reacted to the prevailing bearish news, leading to rapid, high-range candle formations. These types of sharp, decisive candles are characteristic of liquidation events and strong directional market sentiment. While the bounce from the $3,302.30 low has been visibly present and somewhat steady since the initial plunge, a critical observation remains its relative lack of aggressive buying volume. This contrasts sharply with the substantial, impulsive selling volume that pushed the price down initially, strongly suggesting that the current recovery might be more a product of short covering and technical bounce than fundamental new demand from long-term investors. The resistance level cited extensively in the news at $3,345 is indeed a very clear and formidable overhead hurdle on this shorter-term chart. The price has not yet managed to decisively test or overcome it, indicating its immediate significance. This confirms $3,345 as an immediate, strong resistance zone that bulls will need to conquer convincingly, perhaps with multiple strong closes above it, to signal any meaningful short-term strength or a potential shift in the narrative. Furthermore, traders utilizing this time frame for tactical entries should pay exceptionally close attention to specific candle formations. Long wicks on the downside after dips could indicate immediate buying interest and potential rejection of lower prices, while prominent upper wicks near resistance could suggest renewed selling pressure and rejection of higher levels, offering clues for shorting opportunities. The intraday VWP could also serve as a dynamic resistance or support, helping to identify intraday trend strength. Let's now revert back to our daily chart to place these recent, intense market movements into their broader, long-term context and thoroughly assess their larger implications for gold's overarching trajectory. The decisive breach of the $3,302 support level is undeniably a significant technical event for XAUUSD, potentially marking a transition from its previous strong bullish trend into a more protracted, uncertain, or overtly bearish phase for the short to medium term. This breakdown indicates that a prior established floor has given way, opening the door for further downside exploration. Considering this significant breakdown, the previous major swing low, meticulously recorded around $3,256 from late June, automatically becomes the next critically important and formidable support level to diligently monitor. Should the current, tentative rebound falter and price continues its descent, $3,256 would represent the next logical and potential area where truly significant buying interest might realistically reemerge, forming a new floor. Conversely, on the upside, immediate overhead resistance levels can be clearly identified at $3,345, a level widely referenced in recent financial reports and currently acting as immediate resistance from above. Beyond that, we have more substantial and entrenched resistance areas, firstly at the $3,390 area, which until recently functioned as a minor support but has now flipped into a resistance zone following the price breakdown. Further up, the critical resistance is at the recent swing high around $3,433, representing the top of the current consolidation or distribution range, and a major hurdle for any sustained bullish recovery. A concerning and consistent observation on this daily time frame is the continuously declining volume accompanying recent meager upward price movements, especially when starkly juxtaposed against the sharp, robust selling volume seen during the downside impulse moves. This marked divergence in volume dynamics strongly suggests that bulls are not yet establishing sufficient conviction or market participation to sustain a significant upward reversal, indicating weak demand. It's absolutely paramount for long-term traders to remain cognizant that the overarching, long-term bullish narrative for gold, primarily driven by its established role as a global safe haven asset, could still powerfully reassert itself. This scenario would most likely unfold if unforeseen global economic instability were to intensify dramatically, or if geopolitical tensions were to unexpectedly escalate, thereby rekindling robust, fundamental safe haven demand for gold, overriding bearish technicals. Additionally, a pivot towards an unexpectedly dovish shift in the Federal Reserve's monetary policy could also act as a major bullish catalyst, weakening the US dollar and making gold more appealing. Let's now pinpoint our focus even more tightly on the 1-hour chart, specifically examining the last few hours of trading activity on July 29th, leading right up to our current analysis on July 30th. In this compressed, short-term view, we can clearly observe that the price has entered a phase of relatively tight consolidation, largely ranging between the $3,320 and $3,330 levels after experiencing the earlier, more pronounced volatility from the breakdown. This recent consolidation period strongly suggests a temporary state of equilibrium, where market participants are actively pausing to absorb and digest the implications of the latest news and patiently await fresh, impactful catalysts for the next directional move. For those considering a short-term bullish entry, a truly decisive break and sustained close above the $3,330 resistance level would be absolutely essential. This upward breakout would need to be convincingly supported by a significant surge in real buying volume to signal genuine bullish conviction and a potential short-term trend reversal, rather than just noise. On the contrary, if the current consolidation breaks to the downside, specifically a clear breach and sustained close below the $3,310 level, this would likely trigger renewed and accelerated selling pressure. Such a move would probably lead to another rapid test of the critical $3,302 support, further reinforcing the prevailing bearish sentiment that has taken hold in the immediate term. Monitoring these narrow price bands for a clear breakout or breakdown is paramount for discerning short-term tactical trades, as these consolidation patterns often precede larger, more sustained directional moves. The formation of doji or small body candles within this range suggests indecision among buyers and sellers, amplifying the importance of the next catalyst. To succinctly recap our comprehensive analysis for XAUUSD, gold has indeed confirmed the prevailing bearish sentiment that permeated the recent news cycles, evidenced by a notable and impactful break below the psychological $3,302 support level. As of our current analysis on July 30th, the price is precariously hovering just above this freshly established critical psychological support, visibly attempting to stage a short-term rebound rather than a full reversal. The most crucial price levels that every diligent trader must observe are immediate downside support at $3,302, which is now being retested from below after its breach, and a more robust historical support foundation at $3,256. On the upward trajectory, immediate resistance is firmly established at $3,345, a level widely referenced in financial reports and currently acting as immediate overhead resistance from above. Beyond that, we identify more substantial and entrenched resistance areas, firstly at the $3,390 area, which until recently functioned as a minor support but has now flipped into a resistance zone following the breakdown. Further up, the critical long-term resistance and major hurdle for any sustained bullish recovery lies at the recent swing high of $3,433, representing the top of the current potential distribution range. Based on the confluence of prevailing technical patterns, the recent strong U.S. economic data, and the anticipation of a potentially hawkish Federal Reserve decision, our unbiased prediction assigns a moderate likelihood, approximately a 65% chance that XAUUSD will continue to test the downside. This downside continuation is particularly reinforced if the upcoming Federal Reserve decision signals further tightening of monetary policy, or if the trend of unexpectedly strong U.S. economic data persists, which typically strengthens the U.S. dollar and depresses gold. However, it is equally important to acknowledge the alternative scenario. There remains a significant 35% chance of a more substantial bullish reversal in gold's price. This bullish reversal is most likely to gain strong traction if unforeseen global economic instability were to suddenly intensify dramatically, or if geopolitical tensions were to unexpectedly escalate, thereby rekindling robust, fundamental safe haven demand for gold, potentially overriding bearish technicals. Additionally, a surprising pivot towards an unexpectedly dovish shift in the Federal Reserve's monetary policy, perhaps hinting at rate cuts sooner than anticipated, could also act as a major bullish catalyst, weakening the U.S. dollar and making gold significantly more appealing. Such a powerful bullish move would be unequivocally reinforced and validated by a sustained, high-volume break and hold above the $3,345 resistance level, ideally followed by a breach of $3,390. Beyond focusing solely on price action, astute traders should vigilantly monitor all upcoming economic news releases, especially those directly pertaining to U.S. inflation figures, employment data, and any forward guidance or statements from the Federal Reserve, as these will exert profound and immediate influence on gold's short and long-term trajectory. Finally, always pay exceptionally close attention to the volume accompanying any significant price movements. Consistently high volume during breakouts or breakdowns provides invaluable insight into the genuine strength, conviction, and sustainability behind those moves, helping to differentiate true signals from false ones. Thank you for investing your valuable time with Explain the Charts, and as always, remember to conduct your own thorough due diligence and trade wisely, meticulously managing your risk exposure.